Right, it is recording now. Okay, hi, we are only 4 today, including me, but that's okay. I mean, it's only the beginning. Hopefully there will be more people next time. I'm going to start sharing my screen. And right. Okay, I don't have the, as I said earlier, I don't have the disclaimer page, but I don't think it really matters. I mean, we're going to touch on really something educational and nothing else. So I have no idea about expectations. I'm just sharing my little knowledge, and I'd like it to be a training group and not just a training course as such. So I'm going to introduce a topic, and then I'd like we can discuss and we'll answer questions. And hopefully within 1 or 2 sessions, I'll be able to really steer the group towards what people are expecting, would like to learn. Okay, first thing is that for people who know me, yes, I enjoy research, I enjoy theoretical stuff. But I understand that I sometimes, actually often, face some resistance, people who are not as curious as I am, and that's fine. I just believe that when most training courses and mentoring or any presentations where there's something like a prerequisite that you should know your goods. I think that's why today we're going to go into that more specifically, because not only I think it's a base knowledge. I mean, there's not possible to go around that one. And for people who have a longer experience, I have noticed, and I'm sure most have noticed, that a lot of rule-based strategies don't seem to work. And you start tweaking and you depart from the rules. And so it can be quite disturbing for people who just want a routine, to just want something easy to grasp, easy to understand. And there's always that dilemma or paradox between trusting rule-based strategies and backtesting, and on the other side, being very knowledgeable and going by knowledge and intuition, and be able to adapt to each and every situation. I am more inclined towards the latter, but I can understand some people either feel frightened or they don't want to think out of the box too. That's fine, that's fine. So we are going to scratch the surface, and maybe there's no disclaimer, but there's a warning or something that is quite important right now at the beginning, is that this is a very complex field. I've read and studied a lot of research papers from masters to PhDs, and it can go really, really ballistic. So we are all somewhere along the food chain, and we have to remain humble. And I will make mistakes. There will be questions I won't be able to answer. But if there are questions I can't answer, I will try and find an answer by the following session. So just, this is really, to me, this is the disclaimer. The important preamble is that, yes, I don't mean to know everything, far from that. Okay, so also the rationale is that I have had really a lot of problems trusting option view. Customer user for a number of years, but I realized that in low IV modeling didn't work. I mean, I could dig out some screenshots I did at the time. There are things that really didn't look correct. Again, I'm not blaming, even though they're supposed to be the reference. But yes, it's difficult to. I mean, now that I have actually started coding my own stuff, my own SOAP, simple options analysis program, I realize the difficulties. But at least now I've done more than digging. I've really confronted myself with the equations and coding, and now I know what it's like. And I'm not saying that you have to follow my path and go along and design code or your own software, but at least if you follow along for some time, you will be able to understand. I know that there's at least one guy, I don't know whether he will be joining us today, but there's actually one guy who now is going full on with coding his own platform. My own software, this trading group is not a platform for me advertising for it. I mean, you can use any software, one or whatever. But of course, I will be using mine from time to time because that's where I actually get across the issues with modeling. There is that story about backtesting. I've been ranting about backtesting for a long time. Yes, but this is going. That's and I will support my opinion, my thinking with some references in another session. Because nothing is black or white, but and there may be a need also for some introduction to basic statistics, but that will be for another session. Again, that will be according to what you're expecting this group. I see this. I don't know where the questions are. I'll chat. Oh, audio's not good. No, I'm sorry. I think it's something with my computer. Is it understandable, or because if it's really too bad, I will go using my phone instead. It's really bad. Okay. So not really good or not really bad. There's also a fan just next to me, but so there must be some background noise. This is actually 42 Celsius here in France. It's scorching hot. And we don't, in the north of France, I mean, this is so unusual, there's no aircon. So, oh, it's not really bad. Okay, good. Okay, so let's carry on. Right. Okay, so there's so much to cover. I decided to start with, of course, the model that everybody talks about, knows more or less, which is black. In another session, I will show the variations that black and Scholes, very close variation, which is Bjerksen's and Stensland, which is the by default modeling in TOS. It's really, really just a minor change. I mean, black and Scholes started, I mean, was designed in the mid-70s. I mean, you can read about the history on Wikipedia and Wikipedia everywhere. So, and at that time, the hypothesis was pretty right, I mean, good. But of course, it was a very theoretical model, a valid one in terms of stock price distribution. And at the time, prior to the 1987 crash, the volatility was regarded as constant, or more or less constant, and it was okay. Since the late 80s, 90s, 20s, there have been a lot of updates, variations to the model, and but we will get into that, and including now even support for American options. So by and large, black and Scholes is the standard model for European options. In another session, I will introduce the binomial model, the Box-Cox-Rubinstein, which is usually simpler to understand, but I think it's less precise, less accurate, and it's actually quite computing intensive. And if there's interest, I will cover also the Heston model, which is now a very much more sophisticated model. Oh, sounds issues making it hard to follow what you're saying. Okay. Then I'm going to, I don't know how to do that. Let me see if I can switch the audio. And I'm going to close it. Zoom back up. One second.
Okay, can you hear me better now? Oh, okay, cool, okay. Right, okay, let me share again and let's try. Right, okay, so I hope you got at least something about the beginning of the session. So in short, today I'm going to really talk about Black and Scholes, and in another session I will talk about Black-Scholes, but really at this time it's going to be Black and Scholes and the basic Greeks for about 30 minutes, and then we can go maybe 20 minutes now, and then we'll go through the questions. Because again, this is not a training course. So Black and Scholes, initially, it was designed to be a way to hedge a portfolio. So it was really to assume one risky asset and one riskless asset, and by making sure there are no arbitrage opportunities, and using a predefined assumed this price distribution following a geometric Brownian motion. I thought I could show you what it looks like, but really it's a price distribution that follows a drift. Let me see if I've got some equation here. Okay, and lastly, in the original Black and Scholes, the stock was not supposed to pay a dividend, but again, it's like the rate in point number one. The risk-free rate was meant to be constant in the original Black and Scholes. That limitation or constraint has been relaxed, and the same with dividends. That's why Black and Scholes can be used now for a lot of different assets, and even though it's pushing the envelope a bit, it can also be used for American options. Okay, these are the assumptions. It's just the basic theory. No arbitrage opportunity, possibility to borrow and lend money of cash at riskless rate, which is usually the LIBOR rate. And of course, this is not a rate that a retail investor or retail trader can actually have access to, but this is theoretical. Short selling without any impediment must be allowed, and also it's supposed to be a frictionless market, so no fees, no cost. But there again, that last constraint has also been relaxed in the later versions of Black and Scholes. So this is the awesome or gruesome Black and Scholes equation that they came up with. Basically, it's a differential equation that takes into account, of course, the value or price of the option, the underlying, so the price of the underlying, which is the variable S, the time to expiration. In Black and Scholes, time is used as a fraction of the year, so it's a decimal number. So, for example, 1 month to expiration would be 1/12, starting with 0 being now. And as you can see in the equation, the risk-free rate R is also being used, and sigma, or the volatility or variance, which is generally described as the standard deviation of the stock log returns. If your mic is unmuted, I could answer a question here, because when I found this in Wikipedia, it looks very much like historical volatility described by standard deviation. But in fact, because this equation is closed, as you can see, to have the value of the option, you need to know all the other parameters: the stock, the risk-free rate, the volatility, the time to expiration. So that is called a closed equation. And that's why you either have the volatility or you have the price. But fortunately, option prices are, especially on the CBOE, especially if you trade very liquid instruments, you will have also an equilibrium, so a market price for your option, from which you can actually deduct the volatility. That's why the volatility is here defined as the standard deviation of the stock's log return. So you could be tempted to calculate the historical volatility. I mean, even on Excel, you can just have a list of daily prices or hourly prices. But let's say daily prices over a certain period, up to a year, and you could calculate the log return, which is the log of today's price over the price of yesterday, of that same instrument yesterday. You list in a separate column the log returns, and you calculate using the STDev formula in Excel. You could get the historical volatility. There's nothing wrong with that. But if you plug in the historical volatility into this equation, you realize that you don't get the exact market price for the option. So that's why there's always a difference between historical volatility and implied volatility. And to get that balance right, because that equation is theoretically correct, to get that balance right, you actually deduct the implied volatility out of price using a specific model, and here the Black and Scholes model. I see that sometimes I get other questions here. No, okay. Okay, I'm just covering the basics. If I go too slow, you let me know. So here is the equation. It's probably the only time you will see it. Oops. So this is the pricing of a call. The call uses, of course, the price of the underlying. This is the cumulative distribution. I don't know how you call that in English. So basically, this is the formula using D1 and D2. What matters here is that you can see the parameters that will impact the pricing of the call, and here put, which is almost equivalent thanks to something we call the Putcall parity. Putcall parity is something that is specific to Black and Scholes. There again, you can push the envelope a bit for American options, but this is typically a European, this is typically a shortcut or something that is quite interesting to have, but it only really works for European options. So the same way as Black and Scholes has been modified, updated, upgraded to deal with the dividends, to deal with to some extent, American options. That Putcall parity, which here is the formula, call minus put, I'm talking about option prices, is equal to a discount factor multiplied by the forward minus the strike. The forward, we use a synthetic forward here, and for those who are not familiar with what a forward is, it can be regarded as a futures. So but futures have a standard size and a standard maturity. A forward follows exactly the same principle, but it can be of any size and any maturity. So that's why here I call it a synthetic forward price. And we will see as we dig deeper that it can be calculated. So I know it's theoretical and it can be complicated, but just consider that this is just a formula that you can plug in. I mean, there are Black-Scholes pricer on Excel and many programming languages, and so you don't really need to know more than it is a function of those parameters. The cumulative distribution function, the time to maturity, the spot price of the underlying. Very often for us at Verma, most of us trade indices, options on indices. K, or sometimes called X, which is strike price, the risk-free rate, and the risk-free rate, for the risk-free rate, we use generally the US dollar LIBOR, or for the euro, it's going to be something we call the Euribor. And of course, again, I'm not going to be repeating myself, but sigma is the volatility, which is the important thing. And I'd like to emphasize something, because, of course, this piece of knowledge you will digest and eventually reuse. It's going to become part of your normal assessment of the market and everything. But if there's anything I'd like, if not at the end of this presentation, but over the next few months, is to take away that volatility is the essential part. A lot of people make hasty shortcuts, in my view, by saying that because we are market neutral traders, I would say most of us, we trade delta. No. We trade volatility. We trade volatility over time, and delta is usually easier to hedge, easier to manipulate than Vega, than volatility. So, of course, this is just a short presentation. I will try and distillate some theoretical information as we go along. I don't want to go too deep now, but if there's anything I'd like you to really understand is that once you get your basic understanding of those equations and the Greeks, what is most important is to understand that you manipulate delta, but what is your risk as a net seller of volatility is that you need to manage your exposure or sensitivity to volatility. Okay, that I will leave for questions if necessary. So I'm not going to go too far. I'd like actually to answer your questions. The Greeks some beginner traders don't even know what the Greeks are, or even worse, sometimes I see people who trade the Greeks, but they don't quite understand what they do. To my surprise, and that's an understatement, I've seen a lot of people trading with no platform whatsoever. I mean, and when you trade in Europe on IB without a platform using the TWS, this is a recipe for failure. So I'm not saying that you need a strong understanding, but you need to be able to visualize. Visualization is a good proxy for the theory. But the most important thing will be to manage your position, to know your Greeks. So and the common Greeks are delta, gamma, theta, and vega. There are many more, and if there's any interest in another session, I will introduce Verma, which to me is an important one. But let's just start with, for example, delta. Here are all the calculations. The good thing about Black and Scholes that okay, it has that quirk or that limitation, so to say, that it is a closed equation. So either you know price and you can figure out what volatility, implied volatility is, or you have volatility and you can actually project what the price should be. But the good thing is everything is in an equation. By resolving the derivative, the gradients, first degree or second degree derivatives of the price equation, you can actually get a formal equation for your major Greeks. So delta will be this one for coal, that for puts. Again, it may look complicated, but just think that it is something pre-coded that you can get in Excel or somewhere else. Some Greeks are the same on both sides, puts and calls. Theta, I also hear a lot of times, okay, market makers are really seeing theta, which is to me a bit of a misnomer. But I hear that. Very often we will see that, okay, there can be dynamics at certain times of the day when market makers and large institutions are actually squaring off their portfolio, their books. So there can be some premium release, which is then understood as some theta release, because of course theta being the value of the position time decay, or if you are theta positive, the time value that you can get. If you're theta positive, time decay will be on your side. If you're theta negative, it's going to be the opposite. But again, it's just to make things a little bit clear, is that theta, of course, it is not something that you get out of your option or options or combos or complex position, but because some market makers are really seeing some theta. All those equations, as you can see them, even if you don't dig too deep, you realize that they are all partial derivatives. So they all interfere with each other. And it can be that volatility has been as reduced, and your Vega exposure, your Vega makes your trade, your P&L look better, and that is often construed as theta being released. All these are kind of acceptable, even if theoretically they are all wrong. What is important to understand is that they are all partial derivatives. There's no way you will get your theta at the end of the day compared to what was announced the day before, because it's as we all often say in physics, it's with all other things being equal. So if nothing else changes, yes, you will have most probably, and that's just, at least in theory, not in practice, but it should be close enough. You should have, at the end of the day, your theta value reflected on your P&L if nothing else has changed. I have mentioned here rho, which is a sensitivity to interest rates. Now that we are in a low interest rates kind of era, it is less important. But I can tell you that in the early 90s, where with interest rates fluctuating quite widely, rho was at the time more important. But I would say for beginner to intermediate level traders, we are going to focus mostly on Vega. Theta is whatever will come out of your trade if everything else works okay. So we are going to be focusing mostly on Vega, and today maybe more on delta. So delta is that partial derivative of the option price versus the underlying. So that's going to be what's your option. And of course, if we look at the combination of options, the deltas of each option can add up. It's actually very simple to calculate the Greeks of any combo, because you actually add or subtract the Greeks of each individual option in your combo. So that is quite simple. So delta will be a number between 0 and 1 for a long call, and 0 and -1 for a long put, and vice versa if you go short. On many platforms, you see your delta from 0 to 100. Some people believe that it's to make things easier than using a fraction, but it's because your option does have a multiplier. If you buy one call of whatever underlying, and if you exercise or whatever the value is at any point during the life of the option or at expiration, and the actual value of that option will be the underlying times a multiplier. So for example, on SPY or SPX, it's going to be 100. So that's why the delta on the platform is usually displayed or quoted from 0 to 100. But that multiplier will be 50 for ES futures, for example. Okay, so delta from that D1 here, as you can see, this is D1, and ND1 is, I mean, again, it's not really important, but this is this equation. So you can see here that not only this is a differential equation, and no, it is actually a differential equation, because you can't actually separate, excuse me, every time I talk too long, you can't actually take out the effect of sigma or the volatility or the effect of time in the calculation of delta. So delta will also evolve as time goes by. And that's why there are, if we could actually look at Wikipedia, where you can actually even see more complicated or more sophisticated Greeks. For example, the variation of delta over time, which, if I'm not mistaken, is called charm, and which can be interesting for delta hedging or late in the position. But when you trade, I would say most of us trade, except for weeklies maybe, but most of us trade longer term strategies where we trade delta, and it's going to be important to, of course, understand that because it's a partial derivative, and again, that theoretical phrase, all other things being equal, is usually just good in theory, but never in practice. So it's going to be important to understand how Greeks interfere or interact. And we will go deeper into that in other sessions. I said that I didn't want to go too far before we go into questions, so that's I've shown. Oh, well, I've actually finished this presentation. So I think it's going to be, I can actually go deeper, for example, and explain more about the geometric Brownian motion or things like that. But again, because this is the first time, I would like to maybe answer questions of yours, if you have. Oh, I see Gary's here. Hi, Gary. Okay, so would you have any questions? If you want me to set the level of these presentations higher, go deeper on, for example, I know that in TG1 I have often talked about SOAP and volatility surface. I thought it could be a bit like diving at the deep end to introduce volatility surface in the first session. So that's why I'm going to go really step by step with the Greeks. But would you have any questions for now? Okay. Would you like me to go to a higher level? Or I thought in any case for the beginning, this, I know I'm just scratching the surface and most of you understand all of that already, but I must also take care of people who are going to listen to the recording later. The math is a bit deep for me, but interesting in learning something about Verma. Verma is the second degree derivative. Verma is what could or would, that's something I've said already on several occasions in TG1, is the same way as delta, because of the interference or cross derivatives, delta is Vega dependent or volatility dependent. Verma is a second degree derivative. So for people who are quite accustomed or familiar with gamma being the second degree derivative of delta, which is something that in most cases, we don't really care about if we exit a trade 14, 21, or 28 DP. But gamma becomes an issue closer to expiration. Because you'll, of course, I mean, let me show option view. I'm going to share my screen again. Of course, none of those platforms, one or option view, have Verma, and that's also the good thing about developing your own software, is that you can really have what you want and what you need. Let me share my screen again. Okay, well, this is one of my positions. It's actually a weekly. But for example, if you look at the various t plus 0, t plus n, you can see that the convexity increases, which means that today I've got a gamma of 0.91, and if I go to t plus 6, I don't know how to do that with yeah, you can see that the gamma will increase to, well, actually this trade is usually quite gamma resilient. But if you have a, let's go for a new position, new trade, and we are going to make like a 2 weeks trade, just a typical broken butterfly. Let's say 2030. Okay, this is a typical broken butterfly. Today it's got a gamma which is fairly flat, and oh no, let's go back to t plus 0. Yeah, so I've got 0.18 gamma. So this means that this delta will not move much if the underlying moves by 1 or 2%. But as time goes by, as the t plus n will go closer and closer to the expiration shape, the gamma will, of course, increase. So gamma is the second degree derivative. So this is the first degree derivative of delta. So it is how quickly delta will change if the underlying changes. And Verma is the exact same thing, but for Vega. So all platforms show Vega. They don't actually show any cross derivative, how Vega impacts your delta. Most people will say that's okay, as long as it is calculated correctly. This delta in the equation will take care of the Vega exposure. Yes, fair enough. But Verma, for example, will be the second degree derivative of Vega, which means that how do you see, you can actually have some idea of it, because you can see that when the the price changes, Vega changes, so you can actually figure out the variation of Vega, but that's going to be using for the x-axis the price, not volatility. So you have no idea how Vega evolves according to volatility if you don't have Verma, which is the equivalent of gamma to delta, which is how our Verma will increase. Our Vega will, for example, increase if Verma is picking up. And I don't think in my presentation. No, okay. Maybe I can go to Wikipedia. Sure. Greeks. Varna is another one. Okay, but let's go to Verma. If we look at, oops. Can you still hear me? Oh. I have a problem with my computer. Okay, here's Verma. Okay. So here you can see that Verma is basically, the D1 and D2 are the same. But what is important is that sigma, the volatility, is the denominator here. So when volatility is low, like we had in 2017 up to the large correction early 2018, when sigma is or volatility, implied volatility is small, Verma will be large, will be a large value. So it's quite interesting to check the Verma value, because if Verma goes ballistic, it means that a small change in volatility will have a large repercussion on your Vega. And that's exactly what happened in early Feb 2018. Verma was sky high because we had VIX around 9. I mean, I think all-time lows or 25-year lows. So Verma was very large value. And so again, if you have that derivative of Vega that is large, it means that a small change in volatility will have a kind of an exponential effect on your Vega, and not even mentioning the effect on delta, because again, because of all those cross interactions, it showed how quickly your T+0 sank when volatility surged enormously. I hope I'm answering the question, but let me see the chat here. Where's that? Sorry, I'm still. I don't know where it is. Oh, there it is. Okay. For future topic, does the ratio of the Greeks have practical applications? It's funny that you mentioned that, because for my baby rhino, I only traded by Greek ratios. That's also something I've mentioned on TG1. That is that a weekly trade is a theta trade. As we go into more detailed sessions, I will start showing charts about. I mean, you probably have seen on the internet how theta accelerates within the last. I mean, I'm talking about ATM theta, because also we have to look into variations of the theta curve according to the position in the chain. But if we look at ATM, so at the money, and at the money options, its theta will accelerate in the last 30 days, and even more so in the last 14 days to expiration. So that's why I say that most of the time the most important criteria for weekly trading is take care of your theta. And what can go wrong are your, let me share my screen again, and we're going to go back. I didn't want to, I'm not trying to advertise for my alert service. That has nothing to do with that. But this is just an example. As you can see, let me clear the model. This is a trade that I usually close 7 DT. So it's going to be closed tomorrow. We are 8 DT today. It's going to be closed tomorrow. And the way I manage it is if you want to minimize exactly what I said, which the cross derivatives, to maximize the effect of theta. And again, theta is exactly like for longer term trades, you will manage your vega and your delta. For short-term trades, it's usually simpler because you just want to focus on theta. And if you want to minimize the side effects of cross derivatives, because again, if you look at what I've just shown, which could be complex theory, but just look at them as just equations. I just want to point out that there are lots of moving parts and they all interact. So if you want to focus and minimize those side effects, and that's why maybe this baby rhino, although it's a very simple trade, can be confusing for beginners because I say, well, simple. I mean, you don't need an alert service for that. If you know your tools and you know your basic combos, PCS, CCS, calendars, all you need to do is control your ratios. The best way for me to get my theta out of my trade is to minimize the rest. And I've minimized the vega effect, and I've minimized here the delta effect. So today we are, okay, it's going to be closed probably in less than 24 hours because of time difference. I usually close my trades in the morning. So I probably won't get $127. But I'm saying that by minimizing everything else, I'm probably going to be getting another $60, $80 out of this trade by the time I close it. Because I make sure that I don't have any, I would say, hindrances from other Greeks. Does that make sense? So maybe I haven't answered the question on Verma very clearly, but I think I can't get the chat box here. I don't know what to do. Okay, I'm going to stop sharing it. So yes, to answer the question, delta over theta or vega over theta. Oh, delta over vega ratio. That's an interesting one. I don't know anyone who uses that, but it could certainly have an interest, could be of interest in some form of hedging. Yeah. Of course, I'm a bit biased because I am a trader. I also trade and teach or mentor. But of course, the bulk of my trading is ATM trading. I trade near the money, slightly bearish as you all do with your RTTs. But if you are if you place your trade further out of the money, you may have different dynamics. If that's of interest to you, for example, if you trade the STT or other longer term and further out of the money trade, when we look at the different Greeks and how they evolve differently so far out in time and so far out also in the option chain, that's something that we can look into. But for now, at this beginning of this group, I just want to and it's also because I'm more familiar with that. So it's going to be more about ATM trade, and apart from this example of the weekly trade, it's going to be more trades that we tend to keep 30, 40 days starting 75 or 80 or 90 days out. I mean, that's, I understand that the options world is so versatile, and I can only engage everyone to learn the specific dynamics of your trades according to their characteristics, and you can't really replicate easily what you know for an RTT or let's say a bearish butterfly. Notwithstanding the different combos as such, it will also have different dynamics because it may be further from the money and also a trade that you start earlier to close earlier. Okay, any questions? If there's no question, if you can point me towards what you would like to learn about next week, that would be great. If not, I'm going to carry on with the Greeks. I'm going to show those charts, the evolution of, for example, theta, according to the position in the option chain and the time to maturity, and because it's also good to slowly but surely I will get to the vol surface. The vol surface is to me the most exciting topic. I know that Gary is very much into it as well. He's done a lot of work on TOS, so maybe we'll also take part in. I'd like this group to be more interactive. I wouldn't want it to turn into a training course as such. Right. We're close to an hour, and I'm going to listen to Ron Bettino on top of the hour. So if that's okay with you, I'm going to close this session. But thank you for joining. I hope there will be more participants next time. Okay. Bye for now.